This video is a part of our investor education series and our endeavor towards kind of building a broader knowledge base around investors in India. Uh, why are we doing this? Most students or people who start earning end up spending way too much early in their careers. Everyone has a sort of a notion in their head that I need to have X amount of salary or X amount of saving before I start actually investing somewhere. Uh, our idea is to kind of help you build that discipline a little bit early. We'll show what what happens if we start early and what happens if we start late as we go along. We do not do any sort of investment advisory. We do not recommend any product during the course of this presentation. This is a completely free initiative to build investment knowledge. If we do take the names of any of the products that are available, that is primarily to show as an example. Please do not treat that as a recommendation, right? So that's the broader contour of what we are looking at in the context of this session. Now, why are we doing this? We're kind of starting with a broad philosophy of investing, and then before we go ahead, I'll have a few questions for us. Most of us kind of have a sense that we get a certain amount of income, and from that, we remove our expenses, and then something that is left is what is called as saving. It will be really useful for all of us to probably understand that this is a wrong way of going about doing savings or investment in general. You should just, as a discipline, turn it around in terms of income minus a defined, whatever that number is, saving slash investment is what is left for expenses. Otherwise, otherwise there is never enough money to kind of spend, and you'll always keep spending it. And this is from a broader set of experience of a lot of people early in their career. The first 2, 3, 4 years of your income basically goes off in a jiffy. You will not even realize where it went. It's much simpler to actually start building that discipline if you just understand that this second equation is the way of broader philosophy of investing in life. You'll probably thank us about 5, 7, 10 years down the line, right? That's all that is there. It's as simple as this. Don't go by the first equation, just go by the second equation. Everything around you will take you to go by the first equation and not the second equation, right? That's the broader philosophy of investing. I have another question for us, which is, do you know how many mutual fund houses are there in India? Companies that give you mutual fund schemes to invest in. So if you look at the results, bulk of us believe, 40% of us believe 25 to 30, a third of us believe 40 to 45, some of us believe 15 to 20. The correct answer is the last one, 40 to 45. Two-thirds of us are unaware of the number of mutual fund houses in India, which is absolutely fine. I mean, not a lot of people. This is much better than a lot of the other people who would be there in the investment world about it, right? So what do we do about it and how do we go about doing it? Simple stuff. There are some myths that are available in the markets. One, I can invest late and cover up. If you're 25, if you're 30 at this point of time, 30, 35, whatever, there's no correct age for starting to invest money. But a lot of the people kind of put it off. Most people kind of put it off saying, I will invest after I reach a certain age, a certain corpus, or a certain amount of salary, and then I'll invest more and cover up. So that's the first myth. Second myth is trying to be too safe, which is not investing at all in instruments which are around things like stock markets and all, because we are unaware or we have some previous experiences of not doing well there. And the third is, I do not know where to invest and I can't find that out. So these are myths which we are going to kind of break and understand. So let's first immediately go ahead and look at the advantages of early investing. Consider an investment of 1 lakh every year growing at 15% rate of return. Compare someone who started investing at the age of 25 and at the age of 30. when they end up their careers at 50, what kind of difference do you see, right? So one person would end at something like 1 CR or here, and the other one would end at about 2.5 CR. In fact, if both of them want to end at the same number approximately, right? If both these people want to end at the same number approximately, if you started at the age of 25 and you made returns at 15%, if you delay it by 5 years, you will need 21% annual return till the age of 50 to arrive at the same corpus, right? Now, the reality is it is extremely difficult to generate 21% return over a longer period of time. Very few people have actually managed that over 20 years. I mean, just to give you a sense, Warren Buffett would be at somewhere around 26, 27% CAGR, right? And so 21% over 20 years is a fairly dangerous estimate to kind of work with. You can actually reach the same career goal with much lesser and reasonable returns purely by investing early, right? Some more numbers. People believe about risk in equity markets. What you see on the red or orange portion on these curves is the periods where you have negative returns. So we have taken rolling returns. What is rolling return? Rolling 3-year return will be 1 Jan 18 to 1 Jan 21, 2 Jan 18 to 2 Jan 21. So if you keep doing this over a 3-year period, there are 13 periods since the beginning of Indian stock market, 13% periods where you end up negative. If you increase your investment horizon to 5 years, you have about 10% of the periods where you will end negative. But if you increase your horizon to 10 years, pick up any date in India from the beginning of 1992 till date, and there is no single 10-year period in which you would have lost money in the equity markets, right? So clearly long-term equity investing works. Short-term, it could give you tremendous amount of shocks, and so that's not a great idea in any case, right? Now, next question that comes to my mind is how much should I invest? How much monthly investment is needed if you start investing, let's say at the age of 40 and plan to retire at the age of 60? Assume you want to build a corpus of 5 crore at your retirement, and let's say you can assume a certain amount of return. Typically your banks will end up giving you a return of about 6% fixed deposit approximately post tax. You have debt instruments like debt funds which will give you a return anywhere between 7% to probably 8, 9, 10%. And then you have equity market funds, which will typically give you a return somewhere in the range of 13 to 15% over a long period of time. Now, there are outliers to this, which is you could have some funds which would have given you a 20-25% return as well, but they are far and few. And the possibility of ending up in one such fund over a 20-year period is more luck than skill, right? So you would have to go with average, returns that would have been expected in the markets, and that would be 13 to 15% in general. So that's your return range. So if you have to assume a certain return, let's say between 10% to 15% kind of a range, how much monthly investment is needed? Another slide that will give you an idea of what happens if you start investing early. My question was age 40, assume a return of 12%. If you assume a return of 12%, to reach 5 crore, you have to invest 50,000 per month, right? But if you start the same at the age of 25, same instruments, you need to invest 7,775 per month. If you end up investing in equities that give you 15% return, to end up with a corpus of 5 crore after 35 years, you just need 3,400 rupees per month. That's effectively 10 rupees a day to be invested in a mutual fund. And that's assuming that you will never grow this investment. You'll keep it at 3,406 per month, 407 per month through the next 35 years. If you keep increasing this, the numbers will start changing dramatically fast, right? I'm reasonably certain most of us who would start working would not find 3,000 rupees too tough to invest beginning the first month of their careers, right? So that's how much you should invest, and that's how much you would work. Now, so the key messages that you get are: one, you need to invest early and regularly, and two, you probably need to invest in equities for the long run, right? Don't try and take out money too soon from equity markets, because in the short run, equity markets can give dramatic shocks. So start your investment early and keep investing regularly, which is something known as systematic investment. I'll explain that as we go along, but broadly, invest in equity markets for the long run. Why the equity markets for the long run is because there's enormous amount of wealth creation that can happen in the long run in the equity markets. Why? Because businesses are growing. What you see on the screen is HDFC Bank, right? Price at about 40 rupees in 2003, price at about close to 1,200 in 2016, 1,800 now, roughly about that, right? So twice of that as well now. So 40 to 1,800 is nearly a 50 times return over a 15-16 year period, right? Asian Paints starting at 20 rupees around the same time, above 1,000 at this point of time, again a 50x return. These are household names which you would have probably seen on the screens all the time during this period. Having said that, obviously direct stock investing is difficult, because it's easy to look at this 50x now and say that, okay, if I had put in 10,000 rupees, then that would have become 5 lakh here. But not a lot of people would have invested for this longer period. B, the chances of identifying one of these stocks in all the stocks that are available in the market is lower, because for every HDFC Bank, you also have a Unitech. Note these are log scales. So the difference between a 50 and a 100 is the same as the difference between 100 and 200. Stock goes to 500, goes back to 5 rupees, right? So you also have JP Associates. Stock goes to 350 odd, goes back to 10, 12 rupees, 15 rupees over a period of time, right? So stock picking isn't everybody's cup of tea. And that's because of a variety of things. Picking the right business is difficult for us as laymen. I mean, technically, whatever understanding we have, we are not tracking these companies on a day-to-day basis. If you are tracking, then that's fine. But if you aren't, then it's a difficult ploy. You do not have access to key information about the companies. What are their results likely to be? What kind of orders they are making? Unless you're tracking them day in, day out. We do not have knowledge of the market cycles. How many of us would have predicted a 2008 kind of a crash? Can we predict if there's going to be a crash next year? And our day-to-day job may not give us time for a constant lookout for such opportunities. So how do you know you will buy an HDFC Bank or a Unitech at the end of it? Right? There are other issues as well. A lot of behavioral issues come up. So you could have bought HDFC Bank at 50 rupees, but once it reached 200 rupees, would you have held it, hoping that it goes to 2000? 99% of the people would have probably sold it. So you wouldn't find too many people who would have ridden this entire run from 50 rupees to 2000 rupees, or in Asian Paints from 20 rupees to 1000 rupees. Technical issues come up. So even if you want to kind of stay invested for the long run, lack of knowledge around a lot of the key events or companies will render it useless, right? So I don't know what RBI is going to do in the long run. I don't know how NPAs are going to play out in the long run. So I may not keep invested in stocks. And the final point is that if you invest, less frequently and not regularly, then there are two ways. You can either invest 5,000 rupees a month, or you could invest 60,000 rupees in a year, right? That ends up at the same amount essentially. The problem with large sums invested is that they catch our attention. You have this urge to go and look at how much is this 60,000 now worth. And if this becomes 1,20,000, which is doubled, you'll very likely to pull this out. If you keep investing 5,000 a month, you wouldn't even feel you're investing a lot of the times. And that investing regularly an equal amount every month is something called as systematic investment plan, right? So equity market can create enormous wealth provided you pick the right business and you stay in the market. And so the simplest solution is to basically buy a mutual fund which looks for a long run investment. Now there are other instruments as well. For example, insurance also tries to do the same, but insurance is an inefficient way to invest, right? The purpose of insurance is to insure and give you a risk cover. If someone comes and gives you an insurance in the form of an investment product, say no to it. That's absolutely fine, right? Exact discussion of insurance is beyond the scope of this particular session, but between a mutual fund and an insurance which doubles up as an investment, you're better off buying a pure insurance and a mutual fund, right? Invest regularly rather than only in lump sum. When I say lump sum, don't invest chunky amount saying, let me kind of put together 50,000 rupees and then I'll invest. And then keep staying invested till the time you believe that the story of the economy is continuing and is not over, right? Now, how do you buy the mutual fund, right? You could buy mutual funds either using an advisor or a distributor, or you could buy mutual funds with a little bit of research at your end itself, right? If you don't understand the question, you can just make a small guess. Between a regular and a direct plan in a mutual fund, which one has a higher net asset value? Just choose. Uh, whether you understand, don't understand, that's okay, but just choose this answer. Let's look at the answers. Nearly half of us believe that the regular plan is going to have a higher NAV, and the remaining half say direct plan is going to have a higher NAV. So I am on a website called Value Research Online, which is basically one of the common mutual fund rating websites that is available. You could use this to identify which are the top funds. And I've just taken one fund randomly. This is not a recommendation. Look at the regular plan and direct plan. So you see direct regular plan here. You have the NAV at 56.42. There's another interesting portion that is there, which is the expense that's at 2.3, right? Let's click on direct plan and look at the NAV for the direct plan here. The NAV for the direct plan that you will spot is 59. The earlier one was 56, and the expense is 1.39. The earlier one was 2.3%, right? Now, what does that mean? Basically, the first thing that you will note is that direct plan net asset value is greater than the regular plan net asset value. Now, what do you mean by direct and regular? The regular plan is given by the advisor or distributor. So there is a small amount of commission built into it, right? Because anyone who's distributing the product will basically make a commission in between. And the direct plan does not include that commission. So that expense ratio is 2.3% here and nearly 1.4% here, 0.9% effectively, right? So you're paying 1% approximately per annum to the advisor or distributor, and that's being cut from your money. That's called the regular plan, and you could invest it yourself, which is called the direct plan. Now remember, when you buy via the advisor or distributor, you will end up paying about 1% every year. And consequently, because you are paying this extra amount, the net asset value in the regular plan will keep going down or be lower than it will not go down. It will not go as much higher as the direct plan NAV will go, right? Now, this is not to say you don't go via an advisor or a distributor. They are a very important, at least the advisors are extremely important in the ecosystem. But make sure that your advisor justifies this over a period, because over a period, this 1% per annum, when compounded, could become significant amounts. And we'll look at that significant amounts as we go along in terms of how do you look at that. So let's actually look at a small Excel file and understand that. So what you see on the screen is a small exercise in investment that you see where you start investing 5,000 rupees monthly, and your annual return is expected to be 15%. So your monthly return is 1 by 12 of that. And I'm assuming that annually this 5,000 will get increased by 10%. So effectively what you're saying is at the end of the 12th month, this is the month here, sorry. And at the end of the 12th month, you are going to see in the 13th month, the investment amount will increase to 5,500, right? You see that 5,500? That's because you've assumed a 10% increase here in your portfolio data point, right? Now, as you kind of keep going along, if you keep doing this for a period of, let's say, 25 years, 5,000 rupees a month, growing at 10% per annum, uh, assuming a 15% annualized return over a 25-year period, you end up with about 3 crore 25 29 lakhs. That's over a 25-year period, right? But here is the fun part. If you increase this number to 6,000 rupees a month, right? And you look at the end value, you increase the end value from 3 crore 29 lakhs to 394. You change this to 7,000 and the value goes up to about 460. So with every extra 1000 rupee invested at the same parameters, you end up increasing the end value of your portfolio by about 75 lakhs, right? And I have done a small table that will give you a understanding of what kind of parameters you might see. So let's try and see that. If you were to do a small bit of sensitivity around this data point, if you are investing 5,000 at a 15% at a 10% increment, essentially. Now, what you see here on the x-axis, or this horizontal row, let me shade that. That's the increment, annual increment. If instead of 10% you end up doing 15% increment every year, you end up with 5 crore instead of 3 crore 29 lakhs. And if you start investing something like 10,000 and keep doing a 15% increment every year, you end up with 10 crore 44 lakhs at the end of 25 years from now, right? And that's the power of compounding. If you can keep putting aside a little bit of money each year and keep increasing your saving each year after that, that is a very, very powerful tool that plays out. And it seems odd that that 10% could play out, but remember that your expenses are kind of fixed to a large extent. When I say fixed, they don't grow in the same fashion as salaries end up growing. So at the end of it, you have the choice of either increasing your discretionary spend by a bigger growth rate or your investment by a bigger growth rate. If you invest regularly and you keep increasing that over a period of time, and you end up with a market like India, which is likely to give a 12 to 15% kind of a return, you're going to end with a lot of money. And honestly, even after 10 years, assuming you start saving something like 10,000 a month and you keep increasing by 10% each year, after 10 years, which is about 120 months, you still end with somewhere around 40 lakhs or so, right? And that's basically the broader power of compounding that plays out. And the longer you keep this invested in markets, the better it is. So primarily, that is the contour that you would want to see. And now there's an interesting thing that we're going to do here, which is let's assume you invest 10,000, so you are going to end here. Just copy this, and I'm going to paste this here, both in terms of the formats and in terms of the values. And why am I doing it is because I want to change this annual return reduce by 1%. Why 1% is because this is the difference between a regular plan and a direct plan. So if you do it through an advisor, what happens at the end of 25 years? And if you do it yourself, what happens at the end of 25 years? The difference is 14% versus 15%, correct? Change this to 14%. The bottom table here shows the returns if you had done the investment yourself. The top table here shows the returns if you had done the investment with the advisor. And the difference, for example, starting to invest 10,000 versus 10,000 growing at 10% is about 90 lakh rupees at the end of 25 years. Now, that's honestly one thing is that it seems like a lot here purely because that 1% keeps going out, but that 1% might be worth it if the advisor is good. It is just that you have to ensure that the advisor justifies this 1%, right? If the advisor is a bank, for example, who's generally trying to sell or cross sell because your salary account is with that bank, that's not worth 90 lakh rupees, surely, because someone has a target. They're trying to achieve their target by putting a mutual fund on your head, and you don't want to go down that route, right? So, what do? Right? Next steps. First things first, you could visit any mutual fund website. Just go to any mutual fund website, Reliance, ICICI, Motilal Oswal, Parag Parak Financial Advisory Services, Quantum Mutual Fund. I've just taken a few, DSP, BlackRock, Mirai Asset Management. There are 44 of these available at this point of time. Some of them are trying to kind of move in and some of them are trying to kind of move out. So 40 to 45. Go to a website like Value Research Online, find out which are the top mutual funds. It's easy to find out which are the top mutual funds and at least start the process of investing. Even if you end up finding a not so great mutual fund, your discipline of investing is going to be more useful than trying to find out the top mutual fund without the discipline of investing, right? Then you could visit that mutual fund's website and they should have a tab called Apply Online. All instructions for us should be self-explanatory. You could also go and invest through any of the online advisory sites. Again, this is not a recommendation. There are 40 of these. Just Google search for robo-advisors in India. You'll find 40 websites, right? Some of the common ones are Kuvera, Scriptbox, Investa, Funds India. These are the more popular ones. They have varied kind of payment structure. Some of them are free. Some of them have payments. You could check those websites to find out. But these are online advisory sites which can allow you to invest rather than going to the mutual fund. These are sort of aggregators. If you think you need help initially, right, you could approach your bank or advisor for the initial rounds of investment. You don't have to continue doing your investment with them. Just start a simple investment of 10,000 rupees. That doesn't need to be a systematic investment. That just needs to be one single investment of 10,000 or 5,000 rupees with a bank. You get the hand over the next few months and then you can move on your own. Or if you get comfortable with an advisor, move with them. And finally, for investing in mutual funds, you need a one-time know your customer, know your client registration, KYC. This takes a little bit of paperwork, one or two rounds of paperwork that happen. It's actually simple if you can visit a mutual fund office or you can get it done by your banker for your first round of investment. But then do it yourself. Once you're done with your KYC, you will get a number which will be attached to your PAN and Aadhaar. So essentially, then you can visit any mutual fund website and it works seamlessly. You don't need to do anything. All mutual fund websites, mutual funds also have apps now, most of them. So you can just click a few of the buttons on the apps and within 3 or 4 clicks, you can actually invest in most of the mutual funds that are available at this point of time, right? That's the next steps that you could see. Obviously, going individually in terms of identifying how do you select a mutual fund is again beyond the scope. We'll probably do some more sessions on those in due course of time. But if I were to just summarize, first principles, invest before you spend. Invest early and regularly, even if you start small. You'll see it building up dramatically fast. And understand that investing is more discipline and less mathematics. So if you are disciplined, wealth builds up automatically by compounding. You don't necessarily need to do anything specific there, right? Just keep that in mind. Try out, just go to a few mutual fund websites, see what kind of funds they have, see what they're doing there. In itself, mutual funds are probably one of the better available instruments if you can't go and invest in stocks directly. And I would suggest you don't go and invest in stocks directly till the time you're confident of your own research that you do. Never invest on tips, right? That's about it in this particular session.